is going to cover all of my interest. But if you looked at the budget, it's 12.3 million, right? 2 million is land. So I've got like $2.5 million worth of soft costs I've got to finance, right? So what are you going to do is you're going to go to the partners for that. And just like you do a construction draw every month for hard costs to the bank to fund the contractor, you as a developers are going to create a draw request that you're going to send to your partners. And you're going to attach invoices for all the different soft costs that you incurred. A very similar process to what you're doing with a construction company. Now what you're going to do is you're going to send this guy at the end of the month, you know, say you need $357,000. You're going to send an invoice for 10% to one guy and 1 to 90% to the other. Now, most of the time, this guy's sending the invoice to himself, to somebody else in the office, okay? Typically, you are the fee developer and you're a partner. So, you know, you're going to pay $35,700. This guy's going to pay $300 and whatever. Your capital account is going to increase, and it's going to earn a 7% return.
At the end.
Currently, you're going to calculate it in a very similar fashion to the way you calculate construction loan. And the problem is,
for a whole. You're not going to pay it.
I'm not going to pay it.
Right.
And the reason you say, so why calculate it? Well, because then that ultimately goes to the waterfall and how you're ultimately going to distribute the profits. And again, it's for a different class, but what's going to happen is there's going to be a sequence of payments. And typically the sequence is you pay preferred returns, you pay capital, you're paying those pari passu, okay, in equal proportions. Then your first break is going to be a profit distribution, typically in that pro rata, pari passu, up until a specific IRR threshold. So if you're paying pref at 7, that first threshold has to be somewhere above 7. So it's going to be somewhere like, say, 9. So you might distribute profits, 7% all the way to 9. Until both partners have a 9% return. But then you're going to jump to the next one and say, now I'm going to distribute 70-30 or 60-40. Yes, sir.
So in this case, the one that you have up there,
I don't have any of that in this case.
Well, yeah, but the sources and uses would be the bank loan would go towards financing the hard costs. And the partner is financing 80%, say 80% in your example.
Both partners are financing 100% of the soft costs.
No, but when you're pulling money out each month, that's my question.
You say pulling out.
When you're sending the guy that you
who is sending who?
Because you have to send a request to the bank to pull out the hard costs for that month.
Okay, let's draw the people out here. So I want to make sure we're all talking about the same entity. I'm going to give you a real-life assumption. Development company ABC is earning a 5% fee, right, on this project from a joint venture that it has entered into with institutional partner A, who owns 90% and he owns 10%. Somebody who works at this company and whatever is going to send an invoice for 10% to somebody down the hall, maybe to himself.
Yeah, I get that. Okay.
But you're getting 100% of those reimbursed.
Right.
Okay? Did this help anybody or confuse people? Or?
A little bit of both.
A little bit of both. Okay.
Watch that one on video.
Okay, the only thing that was left, we already did this at the beginning, the IRR. I mean, and as I said, the way the case was structured, all the cash was paid up front. And so, 2.16 out, day one, 10 million out month 2. Since they're 50-50, they got the same, put the same equity in and got the same cash out. They each got a return of 273. Now, somebody asked me a question. Hey, I'm getting a really high IRR. Yeah. Okay, just sometimes you got to do a reality check. Okay, and you go, okay, let me breathe. Okay, let me see, does this make sense? I put $2 million in, and 13 months later I got $11 million out. That's a hell of a return. Okay. Now, if you got now $3 million in a year and you got 273%, you go, something's wrong here. But like, you know, you got like a 5x return in a year. I mean, it's like you hit a home run. Okay? Any questions on this? Construction period interest. Construction period interest. You need to calculate interest. You need to learn how to calculate interest. IRRs. You need to learn how to calculate IRRs. We're not done. We still have more.
Yes.
Of course we have more. Can't leave at 5. Okay. I'm only... I'm not going to, thankfully, there was a time when I taught this class that fair value considerations were, unfortunately, very important. Thankfully, we're in a much better financial time today, and we don't have to worry about that much. When we looked at development costs and accounting for development costs, we took a look at fair value from the perspective of undiscounted cash flows, right? Undiscounted expected sales value, right? Subtracted from cost to date plus cost to complete. And basically, if we had a number that was greater than 0, the accounting answer was, we don't have a fair value concern, so we don't need to make a valuation. Simple. Expected future sales value, undiscounted, right? Less the sum of cost to date plus expected cost to complete, right? If the product of that was greater than 0, we did not have a fair value issue. If the product of that was less than 0, then we needed to create a valuation reserve. You guys are looking at me. We went over this stuff. You guys had questions on it. Okay, valuation reserve. And that valuation reserve could go up and down in subsequent years. You repeated the test every year. Okay, now we talked about that in the context of development activities. Now we're just sort of looking at stabilized assets. We got to go through the same sort of process every year. Now, you know, expected future sales value may or may not be relevant. I'm going to put this in the context. So, why is this important, right? So, what situations could cause us to be concerned about the fair value of assets that we have, right? So, cash flows all of a sudden don't cover debt service. That's not an issue today, but in 2008 that was an issue, right? You know, all of a sudden major tenants were facing liquidity issues. Tenants were putting space back to us. We were having to make major concessions in order to keep tenants on board, right? So when you start seeing those situations, you may have a fair value consideration as it relates to stabilized assets. The problem that we have in order to calculate fair value for stabilized assets is we need to have market activities. We need to have depth of market, right? Because how do we determine value if we don't get a comp set of what there is out there? But the problem is when we have those situations where we've got tenants with major liquidity issues, people getting space back, is that inventory also tends to remain unsold for long periods of time. And so it becomes very difficult in real estate environments. Those of you who took the capital markets class already would see that if we do a timeline of 2000 through 2015, and we look at real estate sales value activity, we go like this, and we peak out roughly in 2007 with something like $400 billion worth of annual sales. And this is real capital analytics data. What happened in 2009? I mean, it was like,
Free fall.
it was like, you know, 20 billion or something. I mean, it was like, so how do you get a sense for value under those environments, right? So, I mean, look, you can go back. I think in the book there's some guidance on, you can ultimately rely on appraiser instinct, right? So you can look at replacement cost, right? You can take a look at your cost of capital and try to sort of infer what a normalized, you know, NPV for that building would be. But really, the best way to figure out what expected future value is to have comps in the marketplace that can validate all that. Okay, now if you don't have it, you got to do the best thing that you can. Thankfully, we're kind of back here again. Those of you who are taking the capital markets class will see that. I just prepared that slide yesterday in particular. So you see we're almost back at 2008 levels. The only consideration that we have when it relates to stabilized assets versus development and process is we actually can have two situations. We can have assets that we are holding for sale. If we know we're going to sell something and it has a fair value consideration, we need to write down the value. So we write down the value to the expected liquidation value, to its fair value. If we're not holding the sale for asset as part of our portfolio, then we do the same thing we would do with a development. We create a valuation reserve. And we would reevaluate this every year, just like we did with our development activities, and we would increase or decrease the valuation reserve based on market conditions. Again, thankfully, I don't think we've got a lot of valuation or fair value concerns in today's environment that we should be concerned about, but should at least, you know, register that in the back of your mind. Yes, Dustin?
So, is it, I guess, a normal practice to get your property appraised on an annual basis?
Okay, so there's two answers to that question. For fair value accounting purposes, you need to evaluate fair value of all of your assets every year. Your auditor may ask you to get an appraisal done because how does he know what a building's worth? What you may be able to convince your auditor to do is that you're going to internally appraise the buildings, and on a sequential basis every 2 or 3 years, you know, part of your portfolio will be appraised by a third party. From an institutional perspective, most institutions essentially mark to appraisal every year. Again, I mean, we sort of covered this very vaguely in the capital markets class, but when you take a look at private equity return data, when you take a look at NCREIF data, when you take a look at institutions are continually on a year-to-year basis are marking their assets, their investments to market, to the appraisal. And their fees, a lot of times, are tied to those market values. And so whether they are engaging a third-party appraiser to do it, or they're doing it internally, or they're doing a combination, a rotation, I've seen most institutional investors will appraise their buildings every 2 or 3 years, but they will internally appraise it every year, and they will mark their portfolio and report to their client based on those appraisals. Yes?
How do you create the evaluation reserve? How do you set up that based on the...
Right, so let's just, I own a building, I have it on the books for $100 million, 100. I go through in today's market, you know, all of a sudden, I can't service debt, you know, I may be losing tenants, you know. Auditors go out there, we get an appraisal, and the appraisal says that the building's only worth 80 million. That means that I'm gonna lose 20, right? And I've got cost to dispose as well, let's not deal with that. So here's a journal entry. All right, so we would say loss on investments, okay, or fair value reserve, which is a P&L account.
This is if it's for sale.
No, if it's for sale, you actually write off the cost. You're creating a valuation.
Okay.
And now here I would say allowance for fair value, right? So we said it was 20 and 20. So when you show your balance sheet, just say cash, let's add 10 of cash, FF&E, 100, valuation allowance, minus 20, right? And so now I've got, what is it, 90. Next year, we do an appraisal and the value goes up to 90. Now I reverse this. I got an income of 10 this year, and my valuation reserve goes to 90, and I got 100. Does that make sense? In simple terms.
And would that just be on your accounting, and like that wouldn't affect your taxes? Or do you?
This is all GAAP.
All
We
GAAP,
finished
right?
tax this morning.
I'm just wondering if you write off the.
To be
You only do
candid
it at the
with you,
sale.
to be candid with you, I don't know the rules, but I would tell you with pretty high certainty that you're not going to be able to recognize a loss for tax purposes until you incur it,
Right.
yeah. Tell you with 90% certainty, 95% certainty.
98.
Okay, 98% certainty. Okay, now, just a couple of things. I don't, everybody wants, I'm hot too, guys, I'm hot too. Okay, again, things we need to be concerned about. I'm going to just throw these at you. Again, thankfully, when I taught this class in 2008, 2009, 2010, these were issues. Thankfully, they're not issues today. But we should always keep these in mind when dealing with going concern, which we talked about, and fair value. So, general economic conditions. Are there layoffs? You know, right? Are fewer people working? Are internal controls potentially being impacted? You say, well, why are internal controls an issue? Well, because you don't have the right number of people in accounting. They may not, you know, be able to, on their own, identify whether there's valuation concerns. Is there excessive pressure on management or on the board to make or look, you know, like results are better than they are? Take a look at the internal control environment in a company. Look at estimates and the reasonableness of estimates that people are using or have used, useful lives, depreciable methods, etc. Is liquidity a concern? Are there violations of debt or other covenants? Has there been a decrease in the collateral that you provided on debt? Do you have delays on payments, or do you see clients or tenants that have an inability to pay or are struggling to meet? Do you see other general terms or negative trends in the market? You know, people aren't getting credit. You're having credit denied. Do you see other people with non-compliance with agreements? On and on. Inability to sell, inability to borrow money, inability to raise equity. You have to delay or postpone disbursements. All those things are usually bad signs, okay? So, anyway. 2 minutes. Number one, I've been encouraged, I think you probably would have received a request to fill out a class evaluation. I just want to say that you guys are the best students.
You could rate me a 5. Anything I can.
No, listen.
Well, 1 point, sir.
No, listen. I finally discovered this past week that I used to get written copies of those, or summaries if I'd asked, and then for a long time when they went electronic, I didn't realize I could actually find them. And I found them this week, and the only problem that I saw is I went back 4 or 5 semesters, there's no depth of market. So, you know, I get 1 evaluation or 2. And the reality is if you want changes from the instructor that may not benefit you, but if you want to leave a legacy to this world, right? It's only when you provide input that's helpful. Now, you can set up a Rate My Professor account too if you want. That's another way to do it. But no, but seriously, unless I get feedback, unless the other instructors get feedback, unless the program gets feedback, and I would rather suggest that rather than making very positive or very negative comments, write tangible observations. You know, too much work, not enough time. I mean, that stuff's not helpful, right? The case studies are taking 47 hours to complete every week. We have too many case studies when all the classes are put together. I mean, those might be all legitimate concerns. Those are things that I'm seeing, okay? But try to provide constructive feedback, and I promise you I'll look at it, and I know Fred will look at it, and the other instructors will look at it, and the only way that we can make changes going forward is to the extent that you provide input. Now, so please, if we get more than 1 or 2, that would be helpful. For those of you who are finishing the program or are done with me, those of you who have had me for 3 classes, I really do wish you the best of luck. It's been an honor and a privilege, and we still have 1 more test, so we're not quite done. But no, but really, you have my email. You know how to reach me to the extent that I can help. I don't finish the program today. I'm there. So I still stay in touch with a fair number of students. Some don't check in that often, but I do stay in touch with them. And I would encourage you to, reach out, say hello, ask questions, ask for suggestions, offer. I've had students say, hey, I'm looking for somebody to hire. Do you have any good students? We've had a few of those. And so if you can help other students in the program as you move on in advance, that will be very helpful. So stay in touch. I'm going to tell you the same thing I tell all my players. You can be anything you want to be. Honestly, your future is like this whiteboard. You can write on it whatever you want, right? Or as a coach did once, he laid us on the ground, he looked at and said, look at the sky. You can go as high as you want. You can do anything. That's the beauty of this country. My old boss has a boat, which I heard is now, his 65-foot Bertram is now his tender for his real boat, okay? But the boat was called What a Country. It's called What a Country, and it really is an incredible country. For all the defects and the problems that we have, you can do anything you want. Anybody can be anything in this country, okay? There's only one thing you got to do. You got to work for it. It's not just going to happen. It's not just going to come to you. So there is a direct correlation. There is a direct correlation between effort and outcome. I can tell you that. I'm 54, going on 55 years old. There is a direct relationship between effort and outcome. I was telling somebody earlier, when I did a master's, I was working. I got into the habit of getting up at 3:30, 4 in the morning to work. Why? Because I wanted to? No. But it's when I get my work done. I got into the habit that to this day continues, which is I work 7 days a week. I'm not saying that's good, but that's what it took to get through the program. And I think I picked up from it. So sometimes you look at it and think, oh, I don't want to do that. You do it half-assed, but you blow the learning opportunity. And that's what I'm going to, you can bounce along the program. I think most teachers, most instructors will find a way to justify keeping you afloat, or you can attack it. track coach at LaSalle is a good friend of mine. We ran track together. And he always says, the successful runners are not the ones who do the workout that I post. They're the guys that attack the workout that I post. People that understand what their challenge is and go out there and say, I want to beat this. And that's the same thing you got to take with the balance of the program or whatever professional challenge lays in front of you. If you passively address the challenges or the tasks, you will get a mediocre result. But life isn't about being mediocre. There's billions of mediocre people in this world. If you want to make a difference in your lives, strive for excellence. And that requires hard work. So out there, do it. And whatever I can do to help you, I'm more than happy to do it. Okay? So, with that, we'll take a little break. And we'll have a little quiz. And that's it.
Almost brought a tear to my eye, bro.
Chino, longest red.
It was funny because earlier I was about to ask you, how motivational are you when you're speaking to your...
Next,
I'm not that good.
next,
That was pretty good, man.
I used to be more.